Good morning. So you're thinking of becoming a professional trader. That's good. I'm a professional trader myself and I have been so for several years. I have been trading the Indian derivative market extensively, and over the years I have learned many things and have developed a few perspectives. And the idea of the content in this video and in subsequent videos is to share both the learnings and the perspectives with you, hopefully to expedite your learnings about the various processes that are there in the market. So, if you find the content useful and relevant, please do hit a like, subscribe, and if you have any queries or points of view that you agree with or otherwise, do share it in the comment section below. So, let's discuss the prospect of becoming a professional trader. And the first step in understanding the process of becoming a professional trader is to understand what does a professional trader actually mean. So if I were to ask you a question, how would you define a professional trader? What would be your most likely answer? You can pause the video and note down your response. Uh, and if you're just here to enjoy the video, I'll just dive straight into the topic. So here we have a small screenshot or a small slide that I would like to share with you, and in it I have listed out the, broadly speaking, various stakeholders from the trading perspective in the market. So we have a trader, we have an investor, and we have asset management companies. So let us understand what is the difference first between a trader and an investor, or even more appropriately, how do we define a professional trader? So, like any profession, an individual is defined by his core income source. So, a trader is an individual whose income source are the gains from the market. Now, what does an individual do when they get an income? They either spend it or they save it. And the next question is, what do they do with the income that is saved? They generally invest it. That individual who has an income source other than the gains from the market, which is deployed in the market as a part of his overall planning for his saving or her saving, becomes an investor. So, an investor is an individual who has an income source which we have written with the acronym SEBI. That is, he or she could either be self employed, employed, a business owner, or an investor. So, the investor is an individual who has an income source generally other than the market gains, whereas a trader is an individual whose dominant income source are the gains from the market. By dominant, I mean it is possible that a trader has a property on rent which is also generating rental income, but by and large, the actively pursued income and the greatest portion of the individual's income component in the balance sheet comes from the trading activity. So that becomes a trader. Now, the other question that is often juxtaposed is, which is better? Is a trader better or is an investor better? So it is quite simply like asking what is more important, a chicken or an egg? From the ecosystem perspective, both are equally important. And from the individual role perspective, they both serve different roles. Like we said, that a trader is concerned by maximizing his income through gains in the market. The investor is concerned in the most effective allocation of his savings in the market. So these are two different perspectives. A trader's income from the market may be used to spend on his lifestyle, and he or she may or may not choose to invest his savings back into the market. So in balance sheet terms, just to give it a structure, let us just understand. So we have understood the core difference between a trader and an investor. Let us understand from a balance sheet structure an asset. So we know that in order to generate an asset, you need to give it resources. The resource could be time, planning, money, inventory, anything. So a trader's asset actually is the trading system that he or she has developed after work done or purchased, however it may be. An investor's asset are the securities that he or she has in his or her portfolio. So, an investor would look at an equity as an asset. A trader looks as the trading system as an asset. Now, when we talk about liability, one, the critical thing that is common between both the trader and the investor is that they should ideally have no liability, which means that if you have any personal loan, house loan, education loan, automobile loan, any kind of loan, then it is obviously inappropriate for you to allocate your savings in the market because those savings are already earmarked against a liability. So it is often better to square off your liabilities at a slightly higher cost, even if you can do so earlier, in order to give you liquidity in the future so that you could potentially become a trader or an investor. So remember that ideally speaking, a trader and an investor should have no liability on their personal balance sheet, and individuals who invest or trade with borrowed money stand less than 1 in 100,000 chance of financial success. So the money should necessarily come from your saving in order to increase your odds of succeeding in the market. Next, the income source we discussed, a trader's income source are the gains that he or she accrues from the market. An investor's income source could be multiple other sources of income where trading gains may either not be a part of it at all or a very small part of it. Expenses. Now, a trader's expenses are usually quite high. Now, what do I mean by usually quite high expenses? A trader generally, if he or she is profitable, is flushed with liquidity. And when an individual is flushed with liquidity, the individual's prime concern becomes tax. And one of the best ways to, let's say, reduce the tax burden is for the individual to create multiple entities where he can offset the income. Or what it basically means is that if a trader is surplus profit, now note that speculative income, irrespective of your income, is taxed at 30%. So if a trader is in speculative profit, he or she is almost certain to spend it on an asset, even if it is depreciating, in order to postpone the tax liability, as compared to an investor who could be perhaps employed and the income that he has received has been after tax. And logically, that is absolute white income. I mean, even a trader makes white income, but that white income basically can be deployed back in the industry to create assets. So, sum and substance being that individuals who derive an income and then can create an expense to reduce the tax burden are more likely going to do so. And these individuals who are flushed with liquidity are more likely to spend, and therefore a trader's expenses tend to be higher, and consequently their quality of, let's say, their lifestyle is generally better for the ones who are flushed with liquidity. Now, investors expenses in comparison are set to be lower because that is how they make savings. And remember that when an investor, uh, in order to save, has to cut down on expense, and when the investor saves, what he gets as an asset is the securities that he's holding, which are inherently risky, whereas a trader is generally looking at the trading system as an asset. And that's not to say that a trader will not invest in the market, but that becomes a separate component of their balance sheet. It's not the same as income. Uh, Now, the question is to start. Remember one thing, that at the very start, both the trader and the investor put money into their demat accounts, and therefore, at that very start, both of there is no difference between a trader and an investor. But once the money goes into the demat account, if that money is allocated on securities which mandate a short term settlement, for example, a weekly option or a monthly future, that and that settlement is going to be in cash, that activity which is designed towards maximizing cash is definitely trading. Whereas the activity which is designed towards funding up assets, now what do we mean by funding assets? Let us assume you want to create a portfolio of 100 crore. Now, you are not going to put all the 100 crore from your saving account into the portfolio, correct? Which means that you would want your own portfolio to generate money for you. How will that happen? That can only happen when you settle your contracts in order to create additional income, in order to create assets, which will hopefully take you to your goal of a number that is quite high. So therefore, and the the difference is that an investor, since keeps investing into contracts without a settlement period in order to increase the portfolio, we if we leave aside the notional gains that the individual sees, the only way for the investor to do that is by continuously adding money. Whereas a trader who's going to enter into short-term settlement of contracts for capital can use the profit from there in order to create assets. In other words, the assets of the trader need not be funded by the savings account of the trader, or the asset of the trader is funded by the demat account of the trader. And that's a pretty big difference between a trader and an investor. The other difference is obviously very clear. The objective for the trader is to generate additional income sources. The objective of the investor is to deploy his saving effectively. And in this, we finally discuss the last part, which is what is an asset management company or a proprietary trading company and or a portfolio management company. So, by definition, a proprietary trading, so a trader is an individual whose core income source are gains from the market. So, a proprietary trading company is a company whose core income source are gains from the market. But that legal entity is that of a company, and it can operate as a company, which means that as a company, they could hire multiple traders and work into a relationship with the traders in terms of exchange of capital. So let us say you are a trader who needs a capital of 25 lakhs in order to successfully deploy a system which has, let us say, 35% drawdown, and the contracts that you are warranting, trading warrants that kind of capital, and the holding periods warrant that kind of capital, and you do not have access to that capital, and you have back tested your models and you're keen on starting this process, so you obviously meet an investor. That investor tends to be a proprietary trading firm who will give you that capital on agreed drawdown terms, and consequently there will be agreed sharing terms in terms of profit loss, etc. And it's a relationship that is usually amendable and agreeable depending on the performance of the individual who's asking the capital and things of that sort. So that's a proprietary trading firm. They also work with the objective of maximizing gains from the market, but they also earn during their licensing with the trader. So if they're going to give you the capital of 25 lakh, it's not going to be free. There are going to be charges associated with it. But in exchange, you have the ability to deploy your own system. That's a proprietary trading firm. An asset management company, on the other hand, is a business, and like a business, it has salaries, operations, systems, and fixed investments, fixed costs, and their core income source are actually by serving the investors. So how do they serve the investors? They serve the investors by effectively allocating their savings, and and in a bid to effectively allocate their savings, they may choose equity. In some rare cases, they choose derivatives. So the asset management company is incentivized by maximizing their clients and maximizing the asset under their management. A Trader is incentivized by profiting, by leading a profitable system in the market. And an investor is incentivized to outperform most saving instruments that currently exist in the market. The thing that is common amongst all these entities is that they all happen to be in the market. But other than that, um, that's about where all of the similarities end, and each has their own objective and each has their own role in the ecosystem. So, yeah, that broadly about sums up what I wanted to share for this video. I would just like to add another small point on the framework that one needs to follow in the event they are looking to create a career as a trader. And yeah, so this could, I thought of making this as a separate video, but since we are on the subject, I think I'll just add it on this one, and it doesn't make a difference. So the reason why you are watching this video, and the reason why I'm presenting this video, is because at some level both of us believe that, or both of us assume that knowledge is an edge. And if that is the assumption that our knowledge is an edge is an advantage that you have over others, and in this case, we are talking about other market participants. That is, the hypothesis is that a more an individual who's more familiar with the processes of investment and trading is likely to do better in the markets than an individual who's not. So, if that is an edge, then the consequence of that assumption is that we will strive to continuously learn. And when we talk about learning, we are broadly talking about two subsets. One of them is the education part of it. The education means the required skill sets that you need in order to conduct your craft. So, if you're a surgeon, what you need to know, if you're a pilot, what you need to know. So, that's the required skill set that one needs to have, and the mental discipline that one needs to have in order to do what their task asks them to do. The the other important part, the process of educating yourself and acquiring these skill sets, is time consuming and therefore will test your temperament. So the in order to perhaps surmount those phases of boredom and fatigue, you would need to have an awareness of what is your role actually in this entire process. What are you planning to become? Are you planning to become a trader, an investor, an institution, a teacher, an analyst? You need to have that clarity of what aspect of the market excites you, because each one of those verticals have a completely different journey. And on the surface it looks like all of it is related towards buying and selling in the market, but it could be very different as you get into it. And the question, so once we have a clarity of our role, at some level, we know that markets are a place of infinite wealth, and objectively infinite wealth. It's the most fair place in the world. It's a brutal ecosystem. It's like a mountain or a forest, or I don't know, like the ocean. You Weaknesses are severely punished, and it is in this honesty there is a certain charm to it, and the fact that the potential is unlimited truly makes this a place where we need to allocate at least some amount of time and money. And now, if you're going to allocate some amount of time and money, the degree of proficiency and excellence that you want depends on the individual. And of course, it's quite clear that the reason for being associated in the markets is for absolute financial abundance. In the process of these in the subsequent videos, as we go forward, what you will hear me talk about are the technical skills that you need in order to become a trader, which generally means the price action indicators, oscillators, and all the specific jargon that is there related to understanding trading from a technical perspective. System level understanding, which would imply market selection, security selection. How do you reject? How do you select a security, and then more importantly, how do you reject a security? How do you decide on the parameters of entry and exit, and when would you add? When would you, under what circumstances would you book out profits, etc. So these questions, and how much of your net worth would you actually risk? These questions are answered by your system, and which in turn derives the net worth part of it, in turn derives the money management rules. We understand that your position sizing is going to be a function of your system expectancy risk reward ratio, and by position sizing we mean how much percentage equity do you risk per trade, which is obviously a function of how many trades are you likely to execute in a month or in a year, which in turn is a function of your holding period, time frames that you have selected, the parameters that you have identified, etc. So obviously this is derived out of a technical skill, which in turn decides your system, which in turn decides the money that needs to be allocated to that system, and then the attitude of a trader. So the attitude of a trader as compared to those who are in related fields but not in trading. So, those who are in related fields believe that it is about identifying one set of rules and to mechanically follow it with flawless precision in order to get an edge over the market. Now, it may be true, it may be as simple as that. But generally, if you're a professional trader wherein your core income source is trading, and let's assume you have no source other than trading, in that case you are going to focus on creating many profitable rules, because there cannot be only one rule. No, let's assume there is one rule which is profitable, so that's one assumption. Then the other assumption cannot be that that is the only rule which is profitable. So which means that there are, assuming there are profitable rules, then there are many profitable rules, and then in that case, as a trader, you want to build many more rules in order to smoothen your equity curve. So often you're going to, as a trader, you're going to bring in a system with low accuracy but with extremely big winners, and you will equally be compelled into bringing, a system which has very high accuracy but very small winners. So any combination is possible, and the attitude, your attitude should, I feel, at least for about 10 years in trading, should be to continuously build systems and to know your system through a process of documentation and assessment. So, okay, so yeah, incidentally, that's what I've written next. These systems that you build are going to decide your approach, and by approach, I literally mean everything: the times you sleep, the times you wake up, the kind of content you capture, the kind of content you monitor, your blind spots, your thought processes. Everything is determined by these systems that you select, which in turn is determined by the skill sets that you possess. And finally, you review and take corrective and preventive action when you identify some natural shortcomings and some obvious challenges in your trading system. So, yeah, again, a lengthy video, but thank you for your time. This is broadly what I wanted to discuss about the decision of becoming a professional trader, or it could be just simpler. You could simply take a very passive approach to all of this, but then we miss out on what we discussed earlier, that is markets being a place of absolute unprecedented financial wealth. So yeah, hopefully you found this content useful and relevant, and your likes and subscribes are all right. Have a good weekend. Take care. Thank you.